Good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder. This is BRN for Friday, December 13th. And here are our top stories. Skeptical about annuities? Annuity sales fall in Q3 but are still up for 2019. And funding vehicles for health savings accounts. Well, to discuss this and more, Randy Plavaika, senior reporter with Fund Intelligence. Randy, pleasure to see you again, my friend.
Always great to see you, Jeff, and I hope you're doing well.
I'm cold. New York is cold this time of year, 26 degrees. I'm freezing, no hair. You know how it goes. So let's just jump right into it. You obviously cover, not obviously, but you do cover the financial space. And so you look at both mutual funds, collective investment trusts, and also annuities, which are a very important part of the retirement conversation. So what can you tell us about the annuity landscape today?
So annuities in general in 2019 have been really interesting in that they've seen an uptick in interest and awareness. Truly, people seemingly at the ground level are just more interested in the vehicles, whether it's exploring them and learning about them or actually investing in them. This past quarter, Q3, and then even before that, Q2, there were some little sales records in between there for both variable and fixed annuities, which was quite interesting from my perspective, just given the fact that neither of them have really been poised to have a lot of growth in recent years. And all of a sudden, we're just seeing this kind of slight uptick comparatively to the past 5-10 years.
And you're out there talking to many of these providers who create these products. Do you think that, or just based on your conversations, is this just interest from consumers? Is it interest from platforms such as record keepers? Where do you think? Where are you hearing that the interest is coming from?
I think a lot of it is actually consumer based, and obviously there is a demand from platforms as well. But what's happened is that there's been a shift in the language around annuities, and so the way people talk about them now. There are even some websites that are an annuity product advertising site, and they don't even mention the word annuity until the very bottom of the page. People are getting more accustomed to learning about it as being a lifetime income vehicle as opposed to being an annuity. And I think that connotation, shifting that, just the verbiage of it, is really changing people's perception of it, how they're thinking about it in terms of their retirement income, and ultimately opening them up to basically either A, investing in it, or B, asking their advisor or learning more about it.
Yeah, I think you're right. I mean, I think that there has been a cultural shift. One, I think people are more accepting. I think maybe some of these biases and perceptions that they have maybe have kind of fallen off and have been reshaped. And I think, anytime you're talking about retirement income, you have to include annuities, at least in the discussion in terms of vetting it. And I don't see why people wouldn't be open to learning more. And I do think that we've gotten a bit more disclosure from the regulators who oversee. These products are overseen generally at the both the federal and the state level, and I think we've gotten a lot more transparency there.
Yeah, and I would agree too. I think now, especially providers are starting to realize that they themselves need to be more transparent if they want to bring anybody new in as well. So it really benefits the American consumer in the end, because then we're able to basically see a more transparent structure around a vehicle that, a few years back was just kind of a negative word. If you said the word annuity, some people kind of shuddered and pulled back a bit.
Yeah, and we've talked before about the Secure Act, which I think has, it hasn't passed. And I think last time you were on the program, we talked about the Secure Act and what you were hearing. And that includes a provision that would allow for annuity type products in a retirement plan, something that I think many, including people inside and outside the industry, have thought makes sense because, again, generating income can come from a lot of sources, from investment options like mutual funds and CITs, but also dividends, stocks, and annuities.
Of course, yeah. Obviously, we're still waiting on the Secure Act, but I think what is interesting is that, annuities aren't for everybody, but what would be nice is to open it up just for opening up for the people that could afford it or do want that type of retirement income. And so really making all those options available, both through the legislative and the regulatory process, really makes sense. At this point, it's just kind of the more you can lower the barriers, the better you can make it for American savers, where they're at that middle class level, the high net worth or ultra high net worth that want the annuity.
And are you just you and I have talked a lot offline about the fee compression that exists in a lot of different places. You got record keepers, you have advisors, you have investment product manufacturers. All those fees are coming down. Is it your sense, just from talking to people in the annuity, variable annuity, fixed annuity, deferred annuity space, that fees are coming down, dropping? They're not the 200 basis points, which is 2%, that you would typically see in the past?
I don't know if it would be coming down. I think some might consider it, but I think right now the big notion is that when you're buying an annuity, you're buying all the features of an annuity. And so they're going to keep that expense ratio, that fee higher, because you're getting more out of your product. But I do see a bit of an opening from some companies looking to get down market to opening that up, maybe by having like a lower minimum investment or having a lower expense ratio, just so you can get maybe a more average saver into an annuity type vehicle without putting them into such a high cost vehicle. They might not be able to afford the 200 basis point, but maybe they can afford a 50 basis point option. And they're kind of more accustomed to that price range anyways.
Yeah, and just, I guess, for the benefit of the audience, and you can help out here with this as well, Randy, is that when you look at an annuity, like a variable annuity as an example, it usually is managed like a mutual fund, but it has this insurance wrapper, and that's what provides the guarantee. And that wrapper, quote unquote, is where the additional expense comes in, because that guarantee costs money. The insurance company has to build that into the factors that they use to manage their general account, which is where they handle all those guarantees. And so one way, Randy, to do this, we've seen the shift to passive investing in a lot of places. And I'm wondering, just pontificating here, but I'm wondering if we could see shifting in these variable annuities to more passive investments, indexes, or even exchange traded funds.
Yeah, and I can actually give you one example too, in that Jackson is one of the biggest providers of variable annuities, and they themselves are looking more into the fixed index and fixed space as well now. They've historically always been variable, but I think a lot of firms are starting to wonder, how can we expand our options, even beyond Jackson, obviously, is just the example I'm using there. But people are wondering, how can I get more out of my own vehicles and my offerings? And the fixed vehicles definitely do offer an advantage in that regard. You're getting a great deal of guarantee there, especially fixed index as well. And I believe as of the latest numbers, there's been a little bit more interest in terms of net flows going that way. As of Q3, I'm not sure if that's still the sentiment, but I do see it garnering just a little bit more interest in terms of people putting their assets there, or just in terms of people, especially the providers, launching or expanding their fixed and fixed index capabilities.
Yeah, and I certainly think that that's probably a trend that will follow, because that's just what you see in a lot of these retirement programs. People, and generally with retail investors, people going more passive in the traditional asset classes. So why wouldn't it make sense to do that in an annuity structure? And that would lower cost, presumably, because you wouldn't have some of that active management. That would lower the cost and maybe take away, back to our earlier part of our conversation, take away some of those misconceptions that people have: high cost, lockups, a lot of fees, a lot of commissions, no transparency.
Of course, yeah.
So Randy, I want you to stick around if you don't mind. When we come back, we'll talk to Randy about health savings accounts. We've talked about these on the program before, but now investment companies are coming up with specific products for the HSA marketplace. So stay tuned right here on BRN AM. Imagine a new television network that will make you richer, healthier, and in control of your financial future. This network is for the policewoman in Nashville, Tennessee, the baker in Dubuque, Iowa, the teacher in Lexington, Kentucky. We want to make the idea of savings and retirement culturally relevant. But what do you see as a defining issue of the midterms, especially for the smaller businesses? I mean, they are the lifeblood of the American economy. Featuring exclusive interviews, current affairs, and docuseries. 33 years old, you retired early.
The philosophy is money only matters if it helps you live a life that you love.
But you got to start thinking about retirement as soon as you get
The Broadcast Retirement Network will drive very high engagement with premium partnerships. So this isn't retirement and savings for your parents or grandparents. This is for all Americans. And we're going to change the way you think about money. Welcome to the next frontier of retirement and savings. This is BRN, the Broadcast Retirement Network. Welcome back. We're talking to Randy Klabaika. He is a reporter with Fund Intelligence, and he covers the mutual fund and insurance and retirement platforms. So, Randy, really great to have you stick around this morning on this jubilant Friday the 13th. I hope you're lucky.
Yeah, of course. I mean, I'm really feeling it this morning, too. And I think, obviously, the day is on my side. Friday the 13th, no better day to be on the BRN AM with you.
Absolutely. Well, so let's shift gears a little bit. Annuities, very important part of the conversation. People certainly vet them as an option. But now let's shift gears. Health savings accounts, we've talked about it on the program numerous times, an important, potentially important part of saving, not only for retirement, but saving for those ballooning healthcare costs. Now some of the investment managers are getting in the mix in terms of creating specific products for health savings accounts. What can you tell us there, Rand?
Yeah, so actually one of the major players that has really launched a big stake into HSAs has been Fidelity. And obviously Fidelity is known just for being an investment management giant. You know, you name it, they're in it in terms of the product of the vehicle. And HSAs are no different, although they are relatively new to the individual HSA space. So I believe this year with the Morningstar landscape, you really see them making a claim to be in that space. And then number two, they're going to supplement that because I believe soon, 2020 here, they're really going to be expanding their capabilities. And so they have a new mutual fund in the works, specifically geared with HSA investing in mind, which is just very interesting. And obviously, it'd be interesting to see if other investment management companies follow suit to get a stake in the HSA space. But I think what's more important is that Fidelity themselves is getting to HSAs. A lot of times it's been a lot of smaller market, mid-market specialists that are only in there. And once you get one of the big 4 or 5, competing in that space, all of a sudden, I think everybody that's specializing there right now is starting to look around and wonder, well, what do we have comparatively to Fidelity, and how can we compete with them? How can we serve the American consumer as well as a giant like Fidelity?
Yeah, I mean, this is a growing marketplace. You have over 58 million Americans who are invested in HSAs. I pulled some data down before we came on the air. I think the Employee Benefits Research Institute said that only 5% of these accounts are invested. Most are invested in cash. And, typically when you invest in an HSA, Randy, and get your perspective on this, you have a broad array of funds that you can choose from. And, it could be mutual funds, it could be target date funds, but they're really funds that are developed, like target date funds, for example, are developed for retirement. They may not be there specifically managed for health savings account. And that's what we're talking about here, is that Fidelity developing and others developing specific products to make sure that they're getting the assets to a specific point that you're going to use them. So maybe it's not in retirement, maybe it's before retirement, maybe it's later on in retirement as you get, as you age and get further into your retirements. And that's really important because there is a difference between retirement planning, retirement savings, and retirement income, and then health savings and health income. Because a lot of people may not take money out of their health savings account. They may let it just grow and gestate until post-retirement.
And that's kind of the nice thing about the vehicle too, is that it's more supplementary than it is necessary. And by that, I mean, you absolutely can and should have an HSA if you feel that you need it for healthcare costs later down the line. What's nice is that it does have certain tax advantages and certain transfer advantages, wherein if you're not using it, it's not the biggest loss. Unlike when you're rolling out of your typical DC plan, sometimes if you don't lose it, or if you don't use it, you lose it.
Yeah.
And it's like you would hate to be the American consumer on that side. I would hate to be the one to invest all this money into an HSA and then lose it. But the nice thing about the vehicle, like I said, is that you're not losing it. Obviously, you can use it for whatever you want to, for whatever stage. And I think having a mutual fund specifically designed for HSA investing is obviously interesting, because now it's like, well, I definitely know I want healthcare savings. This vehicle is designed to, weather market downturns. It's designed to weather volatility. It's going to have lower returns, but it's guaranteed over a longer period of time, which to me, I'd rather have the safety net of that HSA or that vehicle style as opposed to maybe a higher risk mutual fund or something to that regard that isn't designed to be within an HSA.
Yeah, I think you hit the nail on the head, and I think that longer term, and I'm drawing an upward chart, as you can see. I don't really have I should probably get a whiteboard, like the late Tim Russert had, and do that. Maybe we'll come up with that, or maybe the production team can figure that out. But over a long period of time, you have an opportunity to really grow your assets. And I think what we're describing here is a high deductible healthcare plan. That really is the future. Many employers are going in that direction. And so having specifically tailored investments only makes sense. And I would think that when you're setting up these plans, you'd want to have a more tailored investment array that you have designed as a fiduciary for your participants, for your individual employees.
Yeah, and exactly. I want the best for my client at the end of the day. That is what the fiduciary concern comes down to. I think having an HSA designed vehicle will only end up benefiting the end consumer, and obviously Fidelity is the first to get in this space, and so they put the cards on the table, if you will, and I'm sure now they're just waiting for everybody else to show their hand. We'll obviously see if some of the other big four, big five investment companies, investment managers get into it, but I think right now what would be interesting for me especially is where our mid-market specialists come in. They've been in the HSA space forever, your health equities, your health savings administrators, firms like that have been there, they know this space, they know how to operate here. What is their response going to be? And I think ultimately they're going to have to be a more competitive response if they want to stay afloat, and if they don't want to just become, another item or another, M&A headline in the future because they have the great HSA capabilities, but maybe a larger firm wants them to compete with a Fidelity or something similar like that.
Yeah, I would say, why not partner, with other fund companies? I mean, I think it doesn't have to be a zero-sum game. I think that, not one person or organization has to own this, or not, in the target date fund space, there are really 3 or 4 key players. I don't think that has to be the case here with HSAs. I think there's enough to go around for a lot of people. Partnership is important. And you're right. Those brokers, financial advisors, administrators, they bring a lot of value. They know how to have the conversation with employers, plan sponsors, to understand how to set these plans up, how they can work in concert with a retirement plan, other voluntary benefits. Really important to keep them in the loop and not push them aside. And I think that would probably bode well. And I would expect that, some of these big target date fund manufacturers would think about it. And maybe it's not a target date fund, maybe it's a target risk fund, or maybe it's some other product that, to your earlier point, manages the volatility over a long period of time.
Yeah, of course. And I think partnership obviously offers a really good avenue, a healthier avenue, if you will, than per se an outright M&A or, just buying an HSA specialist because you have the money or the means to. If I'm a giant in the TDF space, I'm not just going to buy it because I want it. It's got to be, in a sense, the partnership is the correct way to think about it. You want to see if this works for you and really leverage each other's capabilities. Obviously, if you have the size and the scale of a firm like Fidelity, every move you make, you still want it to be calculated in a regard. You don't just want to be throwing a lot of money at a certain investment type just because Americans are more interested in it now. Obviously, like you said, everybody can have a slice of the pie here. And I think that, we won't see maybe as much of a consolidation among the top players in the space. It'll be more evenly distributed among people that have been in this space and people that have a great deal of size and scale. That way, there's not so much of a lopsided kind of provider landscape for HSA providers, especially.
Yeah, I don't know if you intended to quote them, but you quoted the police: "Every move you make, every bond you break, I'll be watching you." Randy, always a pleasure talking with you. Happy Friday the 13th, and we will talk to you very soon, my friend. Enjoy your weekend.
Thank you. You too, Jeff.
And that wraps up this episode of BRN AM. Have a financial topic or someone of interest that you think we should talk to? Drop us a line. And don't forget, for all the news in retirement markets, technology, personal finance, so much more, check out today's edition of the Morning Pulse. And don't forget, we're back again tomorrow morning for BRN Weekly. That's our look back at the best shows, best segments for the past week. So until tomorrow, I'm Jeff Snyder. Keep on saving, and don't forget, roll with the changes.
Waiting here for you to take and drink of. But if you're tired of the same